Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Gentherm stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a small cap company, 1.6 billion market cap. They're trading at $50 a share and they have 32 million shares outstanding. Gentherm designs, develops, manufactures, and sells thermal management and pneumatic comfort technologies. They have two segments, automotive and medical. The automotive segment offers climate comfort systems, which include seat heaters, blowers, and thermal electric devices. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Nice free cash flow in 2021, 100 million. That's a 9% margin. Then it became negative in 2022, back to positive in 2023, down to 32 million in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that is positive every single year. 2021 was their best year in terms of margin. Revenue is the sales for the company, and that grew nicely from 2021 to 2023. A little over 1 billion to a little under 1.5 billion. And it's flat into the trailing 12 months. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 1.5 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.3 billion. We divide that by 32 million shares. And we get a calculated stock price of $40. They're trading at $50, so they're trading at a 25% premium. It's a sell according to the model. What's your opinion? Do you think it's a buy or sell? Let me know in the comments. There are 48 companies in the same industry as Gentherm, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a little more than the median in CapEx, 54 million. A good debt to equity ratio, 0.4. For every dollar of equity, they have 40 cents of debt. Free cash flow is a little low. It's below the median. They rank 18th in terms of market cap, which is lower than the average but higher than the median. All their price multiples are worse than the median, but their PE and price of sales is better than the average. So they do seem overvalued according to their price multiples. They generate 1.5 billion of revenue, a little more than the median, a lot less than the average. And it looks like they're still growing. Their 5-year annual revenue growth rate is 8%. Look at XPEL, 30%. Here's their latest income statement, the second quarter of 2024. Revenue is up slightly. It was 372 million in the second quarter of 2023. Now it's a little under 376 million. If revenue doesn't grow at least 5%, they're not even beating inflation. Cost of revenue is all the expenses directly tied to generating the revenue, 280 million. Revenue minus cost of revenue gives you a gross profit, 97 million, up from 88 million. So their margin improved quite a bit because their gross profit is a good amount higher than last year. We're pretty much the same revenue. Their biggest expense is SG&A. That includes marketing, that's 39 million. R&D, 22 million. So operating expenses are down a lot. It was 84 million, but now it's 64 million. The only reason it's down, last year they had a big goodwill impairment. That's when you write down the value of an asset, goodwill, on your balance sheet and pass through the loss onto your income statement. That just implies you overpaid for a company in the past. Now you're writing down the value on your balance sheet. Operating income, 33 million, 700% higher than last year. They spent 4 million of interest on their debt, more than double last year. Net income, 19 million. Last year they had a net loss of 1.6 million. And they did buy back quite a bit of stock. It was 33 million shares last year, now it's 31.5 million. So to summarize, I have them trading at a 25% premium, so they're ranking as 4 out of 10. Would I buy them? 2 out of 10. I'm just not too comfortable on the products they sell. I do need to learn a lot more about the company to get to that comfort level to consider buying them. Ratios 3 out of 10. They seem to be a lot worse in every category, especially price to free cash flow when you compare it to the median in the industry. The only reason I give their financial 6 out of 10 is because their revenue is growing. It went up 40% since 2021. And they don't have that much revenue, but they still manage to have positive free cash flow in 3 of the 4 time periods. So that's the end of the video. Let me know what you think. Give it a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.